Good morning and welcome back to Market Master, Roland Attenborough. It's been a pretty historic week now. A brother of mine, Changpeng Zhao, and my other brother, President Donald Trump, have got together and President Trump has pardoned CZ, and I think that's a really big step forward. I've always cheered for CZ and his programming and his finance project. I've always cheered for him. He's been a really big dude in our corner of the world. So big shout out to CZ and President Donald Trump. Today we're looking at a fragile truth that lifts markets, but can hope outrun history. The world's two largest economies just blinked at the same time, and traders cheered. Global markets ripped higher Monday, and Washington and Beijing said they'd reached a preliminary framework on a key trade disputes, signaling a temporary ceasefire ahead of this week with the Trump-X summit. Dow futures surged 250 points. The S&P 500 futures gained a modest 8%, and the Nasdaq leapt to 1.2%. Powered by risk-on rotation across Asia and Europe. The Chinese yuan strengthened, the Australian dollar followed, and gold sank nearly 2% as safe havens bled. The 10-year Treasury yield pushed back above 4%, a quiet vote of confidence that maybe, just maybe, the worst is behind us. Treasury Secretary Scott Bessent called the deal a very successful framework, promising tariff relief, renewed Chinese soybean imports, and a one-year pause on rare earth export controls. Chip makers led the charge pre-market. Nvidia, Broadcom, and AMD up roughly 2% each, while traders positioned for a double catalyst, a potential Fed rate cut Wednesday, and a big tech earnings gauntlet from Microsoft, Alphabet, Meta, Apple, and Amazon. Soybean futures jumped nearly 2% on the trade thaw. Oil and gold both retreated, unwinding last week's sanction-driven bid. The setup, is this relief or reversal? Markets are acting like they've seen this move before, and this time it ends happily. Inflation is easing, central banks are turning dovish, and trade tensions appear to be cooling. But optimism has an expiration date. The rally now hinges entirely on confirmation, not conversation. A handshake between Trump and X would validate the risk-on trade and likely ignite a year-end melt-up across cyclicals, industrials, and tech. But if talks stall or headlines sour, the unwind will be brutal. Investors signal this week's playbook is simple but dangerous. If the truth holds, growth and liquidity win. Techs, semis, and global players extended. If it cracks, definitive rotations return. Utilities, staples, and cash-heavy balance sheets. Right now, consensus is chasing comfort. Smart money knows comfort never lasts. Every bull run starts as a relief rally and ends when traders confuse hope for policy. The question this week isn't whether Trump and X can make peace, it's whether markets can hold their nerve when the applause fades. There's a $50 billion saying, you'll want these names. Wall Street's big money is already moving, quietly building positions in a handful of stocks before the next rally. Analysts tracked the flows and found 10 companies leading the charge. Some are household names, and others are under the radar, innovators about to break out. Together they form the post-rate cut playbook. Smart investors are following right now. The diplomacy and delay in China's pause is power, not peace. Rare earth stocks cracked Monday, not because tensions rose, but because they didn't. Critical metals fell 9% pre-market. USA rare earth dropped 7%, and MP materials slid over 5% after U.S. officials said Beijing will postpone new export controls as part of a broader trade deal expected at the week's end with the Trump-X summit. That fear bids prices up. The latest signals flip the trade. Washington gets tariff relief, Beijing delays restrictions, and this is a risk off for scarcity. Treasury Secretary Scott Bessent called it a constructive step. Translation, both sides blinked. China still controls roughly 70% of the global mining and nearly 90% of processing. By pausing instead of prohibiting, Beijing buys time stabilizing sentiment and looks cooperative, all while quietly stockpiling materials and tightening informal export routes. For Washington, the delay is just as tactical. It sidesteps a fresh inflation spike, cools political heat heading into an election year, and keeps manufacturers from panic pricing inputs. Behind the curtain, the U.S. is accelerating joint refining projects in Malaysia and Canada, an attempt to dilute China's chemical chokehold without a public fight. Behind the handshake, this isn't decoupling, it's detente by necessity. The U.S. can mine rare earths, but China still refines them into power. Every electric vehicle, wind turbine, and missile guidance systems depend on that chemistry, and that's where Beijing's leverage endures. A handshake in Washington may cool headlines, but the supply chain remains asymmetric. The pause is diplomacy disguised as progress. Investor signals. Well, Monday's sell-off is short-term relief, not long-term resolution. U.S. miners just lost a scarcity premium, but the global equation hasn't changed. Supply is still fragile, and processing independence remains the real catalyst. The next doable and durable rally in rare earth equities won't be sparked by geopolitics. It will be when the West can finally make its own magnets. Buffett's chemical reaction, buying grit at the bottom. Warren Buffett is back where most investors won't go, into the smoke and steel of America's industrial base. Berkshire Hathaway's $9.7 billion purchase of Occidental Petroleum's chemical unit, OxyChem, marks a second rare act for Buffett in a sector that burned him once before. His 2011 deal for Lubrizol never lived up to the legend. 15 years on, revenue barely up 20%, profits flat, and returns lagging the S&P 500 by miles. But this time feels different. Buffett's buying when sentiment's at its lowest, near the trough of the chemical cycle, paying roughly 12 times projection for the 2025 pre-tax earnings. If price stabilizes, earnings could rebound sharply next year. OxyChem's portfolio, PVC, caustic soda, chlorine, ties directly to housing, autos, and the domestic energy buildup. That gives Berkshire leverage to the same forces fueling America's industrial revival: data centers, pipelines, and onshore plants. The pattern? Buying when the dust settles. This move fits Buffett's oldest playbook. Step into capital-intensive industries when others are walking out. Collect steady cash flow and wait for the turn. OxyChem feeds the bones of the real economy: construction, packaging, and industrial materials. As rates ease and infrastructure dollars flow, volume should follow. It's also classic Berkshire positioning: tangible assets, recurring earnings, and the patience to let the cycle reset. Unlike Zuberol's specifically niche, OxyChem sits closer to the economic heartbeat, where scale matters more than story. Investor signals: Buffett's timing says more than his words ever could. He's betting the industrial winter is ending, that the U.S. manufacturing flywheel is about to spin again. If he's right, OxyChem could become the next Allegheny, not the next Lubrizol. For investors watching the tape, that logic points towards diversified chemical and building materials names positioned for housing, infrastructure, and reshoring wave. Follow Buffett's cue. Buy when the factories are quiet. Sell when the machines are loud. Let's take a look at the labor watch. Productivity gamble. Growing without hiring. Corporate America is rewriting its headcount math, and at this time, the answer isn't more people. From JP Morgan to Walmart, executives are testing a new formula. Grow revenue, not payrolls. The same output or more with fewer hands on deck. JP Morgan's CFO told investors the bank now has a strong bias against reflexive hiring. RTX, Goldman Sachs, and Intuit echoed that stance. Walmart plans to keep its workforce flat for the next 3 years, even as revenue rises. At Airbnb, Brian Chesky says AI can make the existing team